I am Vidhura Tennekoon, an assistant professor of economics at Indiana University, Indianapolis campus. World Bank, in its recent report, predicts a substantial global economic slowdown this year. Growth is expected to decelerate from 3.1% the last year to 2.1% this year. This is a worse scenario than the prediction of the IMF in March, just a couple of months ago. And this deceleration is particularly notable in advanced economies, where growth is projected to drop from 2.6% to 0.7%. What does these projections mean? Among other things, these projections suggest reduced international trade. Import demand from advanced economies will drop, and as a consequence, the export revenues of low and middle income countries will drop. Tight monetary policy all over the world to combat high inflation is a major contributing factor to this slowdown. The Federal Reserve, for example, has raised its policy rates by 5% since last March. Such high interest rates are expected to slow credit growth and then economic growth in most countries. And in addition to that, such high interest rates attract global capital towards the advanced economies where the investments are safer, and consequently the low and middle income countries will find it even harder to attract capital because now they have to compete with advanced economies. So they are hit in two ways. In the US, the current tight labor market can absorb this shock. In spite of the projected decelerated growth, Fed predicts the unemployment rate to stay around 4.6% during the next 2 years. However, in other regions with high fiscal deficits and high debt stocks, particularly in Asia, Africa, and South America, the lack of fiscal space to face the consequences and help the people in need is a problem. What precautions will help? One thing people and the governments can do is building emergency funds. Another possible solution is reducing debt through restructuring, for example. Such action may help both individuals and governments.